Yo, what is going on YouTube? What's up? It's Ryan C, Deluxe Trader. If you guys don't know, I worked in a hedge fund here in Dubai and I've made more than $4.5 million in the markets trading independently and with my team. And so today we're talking about supply and demand, why they're important, why it gets misinterpreted, and how you can use it to level up your trading game. Just on a side note, this PDF and many other PDFs, a lot of free education, a lot of different strategies, orb strategies, how you can use leverage. A lot of different PDFs are on my Telegram channel. Those will be linked below in the description, so you guys can check that out. Let's get into it. So right now we're talking about S&D zones, a practical guide to identifying institution levels, entries, and exits. Let's get into it. So let's talk about why most traders fail, especially why most retail traders fail. They chase breakouts. They enter trades too late. See, you can have the right bias, you can have the right trade idea, but if you enter that trade too late, half the move is gone, maybe the entire move is gone, and you're going to end up losing money. They use messy indicators. I've seen people having 6 or 7 different indicators on their charts. That never works out in your favor. And the worst one is using emotion instead of logic in the markets. Would that be revenge trading, greed, fear? When you're in the markets, I say this time and time again, and I'm going to keep saying it, and I'm sure you've heard it before. Take your emotions, throw them out, focus solely on confluences, what the charts, what the market is telling you. Supply and demand fixes all these mistakes because institutions, they don't chase price, right? Institutions move price. Institutions have access to unbelievable amounts of capital, right? They have hundreds of millions, if not billions of dollars, and they move the markets. So our job as retail traders, when we don't have access to Bloomberg terminals and hundreds of millions of dollars, our job is to find out where big money entered, where price moved violently, and where price is likely to return, right? So let's talk about the basics of S&D zones. A supply zone, as I wrote over here, is an area where selling pressure crushed buyers and the price dropped violently. And a demand zone is the opposite. It's an area where buyers overwhelmed the sellers and price shot up. So in supply zones, the price drops hard. In demand zones, the price rises hard the other way. And let me explain to you guys a very key aspect of why markets move in the first place. Why do we see such movements in the markets? Why do we see violent ups and downs and ranges, and what's really happening when the markets move? Markets move because orders get filled. Orders as in institutional orders, massive orders, not you and I, a couple $1,000s. No, massive orders get filled. Liquidity is taken and imbalances are created. This last point is super important, guys. Let me talk to you a bit more about imbalances. So imbalances are a little bit of a complicated topic when it comes to trading, but I'm going to break it down to you as simply as possible. Every asset, whether that be Bitcoin, whether that be gold, whether that be any Forex pair, any asset, ideally has an equilibrium price, a fair price, right? Imbalances happen when that price is not at the equilibrium, at the fair price. You can have an imbalance to the upside, you can have an imbalance to the downside, and our job is to try and find the equilibrium price and find if the imbalance is to the upside or downside. Is it oversold or overbought? If we know, for example, Bitcoin is oversold, then we can buy. Or if it's overbought, then we can sell. So that's why it's pretty important to understand imbalances. Let's focus now on identifying strong trading zones so that you guys know when to enter and when not to enter. Because a huge part of trading, by the way, is sitting out of the markets. Knowing when to sit out, knowing when to let your trade come to you instead of you chasing your trade, right? Focus on explosive departures. What do I mean by that? I mean by mega moves, massive moves. Suddenly, let's say Bitcoin sitting at 90K, suddenly explodes to 100K. Over there, that's when you can start thinking, okay, do I enter? Do I long? Do I short? And you look for clean structure. By clean structure, I just mean a clear bias. Are we trending upwards or downwards? If the market is choppy, it's ideal, especially as a beginner, to sit out because You don't want to be getting into a market that's wicking up, wicking down. You don't want to be, because if you do that, you're going to end up getting stopped out most of the time. Unless you're like a professional scalper, which honestly, I believe unless you have access to super high level, high tech tools, it's really hard to be a scalper. So don't try to trade choppy or ranging markets. So yeah, as we said, strong zones create trend shifts, market structure breaks, sharp price displacements. Weak zones lack structure, choppy price action, they lack significance. Actually, gold recently, after its all-time high, has been pretty choppy, has been pretty weak. And so if you guys are in my Telegram channel, you guys know that I haven't really been trading gold that often, because I try to call maybe once or twice a week if I see several different confluences adding up to a certain trend or a certain direction, but I haven't been trading it as much because genuinely it has been kind of choppy and ranging, weakening upside, weakening to the downside, staying within a very tight price range. And when that happens in any asset, whether it's gold or anything else, I tend to sit out, wait for my setup to come to me. So let's talk about different zone types and the drop-based rally. I'll talk to you about some pattern characteristics. The drop phase is when price drops sharply, indicating institutional selling. Again, institutional selling, not meaning mere you sold a couple shares of Apple or a couple shares of Tesla, or we sold a couple lots of gold. No, this is hundreds of millions of dollars by institutional selling that causes the price to drop, or as I visualize here, an explosive decline. And then you have the base phase. Price consolidates with choppy action. So after that massive decline, we start ranging sideways, choppy action. Again, at this point, ideally you set out. And then the rally phase, and this is when price explodes upwards with strong momentum. And so let me tell you guys a key insight that not many people know. The base is where institutions loaded orders, creating potential reversal. So during this base phase, yes, you sit out, you don't trade, you don't scalp, but you start looking for entries. And if you're a swing trader, this is when you could be dollar cost averaging into your position before the rally phase comes. So this is a quick visualization, a chart example of the rally-based drop. Over here, again, I'll start from the beginning. So the initial price rise, the massive upward movement. Again, we're pausing distribution, we're chopping, we're ranging, nothing's really happening, and then a massive collapse in price. Very important for you guys to note, these base over here, this base over here, I'll go step by step. Right here at this base, this is when institutions are loading up buy orders, right here. This phase right here is where institutions are loading up sell orders. This is when they know the price is going to drop, they know they're going to be selling, so they're loading up their sell orders slowly before the massive decrease. Over here, obviously, they crash the price, and then they collect their profits, and then again the cycle goes on and on and on. They, again over here, either they're going to be loading up buy or sell orders before the next massive move. So let me tell you the 5-step entry model that is going to help you a lot. The first thing to do is mark zones. Mark strong zones from a higher time frame. This is called top-down analysis. So open up the higher time frames, whether it be, start with the weekly, just to get a general idea, general trend, general bias for the market. Drop down to the daily, and then drop down to maybe the 4-hour or 8-hour. This will give you a really good way of identifying the overall trend of that market. And then wait for the price to return to either a supply zone over here or a demand zone. Wait. And then after waiting, after you mark out that zone, drop time frames, drop to a lower time frame, whether it be the 1 hour, 30 minute, 2 hour, and then confirm. Wait for rejection or a structure shift. Once you see a structure shift, one of these candles, enter at the edge of that zone, in the direction of that trade, in the direction of that trend. Your trade should be in the direction of the trend. You're no longer revenge trading, so you can just stick to your plan and no longer use your emotions in the market. A crucial thing that a lot of traders don't think too much about is risk management. So your stop losses and your take profits are so important, and they literally make or break you as a trader. Your stop loss always goes below the demand zone and always goes above the supply zone. Your take profits, on the other hand, should be towards the previous high or the low, depending on whether you're buying or selling, the opposite zone, and equal move extension. Look, you guys should be targeting a minimum of 1 to 2, if possible, a 1 to 3, but definitely a minimum of 1 to 2 R to R. Again, let's talk about the multi-time frame strategy, the top-down analysis I was talking to you guys about. You use the 4-hour or daily charts, you identify supply and demand zones, you find overall market structure, market trend. The purpose of this, as I told you guys, is to map out the trading landscape and identify the overall bigger picture. Then you drop that into lower time frames where you get that sniper entry, whether it be 15-minute, 5-minute, 30-minute, even 1 hour is considered a lower time frame. You find precise entry points and you execute trades at your optimal price. Now the purpose of this one is target specific entries with precision timing. Very important, never fight the higher time frame, always align the lower time frame trades with the higher time frame trend. Look for confluence between time frames for the best opportunities. Guys, if the market is overall trending upwards, don't ever try to look for a sell if you see an uptrend on the hourly. If you see an uptrend on the daily or the weekly, do not look for sells unless you see several different confluences telling you it's time to sell. I can't tell you how many times I've seen traders say, okay, yeah, I'm gonna call the top, I'm gonna short right now. Bro, you can't do that. You can't do that. Trying to fight the trend is the quickest way to blow up your account. And let's talk about some more ways I've seen people blow up their accounts. Trading zones and chop, as we said, destroys your R to R ratio, just overall horrible because you're going to get wicked out. Over marking zones, you can't mark out every single candle. Not every single candle is crucial or important. Premature entries, you cannot enter before several different confluences, before several different confirmations. Tight stops, okay, yes, this one is a bit controversial. You do want tight stops in a sense where you don't want to leave yourself too exposed to the market, because you can have 5 or 6 different confluences and the trade can still work against you. That's happened and that's normal and that's gonna happen. But using stops that are so tight that you can't let your trades breathe or let your ideas breathe is gonna ruin you as well. And over trading, obviously, I think we all know, if you're trading 6, 7, 8 different times a day, you're probably not gonna be successful in this industry, right? You have to take A+ setups every single time you enter. Treat trading like a business, not a casino. This is a bunch of generic information that may sound overused to you guys, but trust me, just drill it into your mind. So again, this is just, I put this in for people just to really drill it in their minds that yes, okay, rules do beat emotion, discipline beats intelligence, and consistency beats excitement every single time. I said it before and I'll say it again. If you're jumping up and down at your table and your blood pressure is rising and you feel like you're gonna have a panic attack whenever you're in the markets, you're probably doing it wrong. Okay, you have to stick to your setup, set it, forget it, let it happen, let it play out. As long as you took an A+ setup, consistently taking A+ setups over time is going to help you grow your account no matter what you do. And so I have a proper routine that I follow. You guys can choose to follow along. It helps me a lot. It's one of the main reasons I've made so much money in the markets. In the morning, I mark my levels. I note the session highs and lows. I like to trade New York session or London session. And then I wait. And then during the session, I only trade around the zones I have outlined. I don't take any random entries, and I follow the supply and demand structure every single time. And then after the session, whether I won, whether I lost, whatever it was, no matter what happened, I take a screenshot of the trade, I journal everything, I write down whether I won, whether I lost. I write down why I think I lost. Was my stop loss too tight? Was my take profit way too far? I just journal the whole trade and what went down. And so guys, the final truth about the markets, you're not going to get paid for being a genius. You're not going to get paid for being emotional or being happy or sad or angry or acting busy with the charts, drawing 20 different trend lines. You're going to get paid for waiting, executing, and repeating, being consistent, and making sure you take A+ setups. All right, guys. I'm going to be dropping a whole bunch more of these educational videos. I'm going to drop one about the orb strategy soon, and just a whole bunch of videos I have in my mind. So if you guys like this type of content, don't forget to subscribe. I'll see you guys in the next video with more hedge fund tricks, and good night.